Good day, and welcome to Cholamandalam Investment and Finance Company Limited Q1 FY24 earnings conference call hosted by Kotak Securities. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Nischint from Kotak Securities. Thank you, and over to you, sir.
Good morning, everyone. Welcome to the earnings conference call of Cholamandalam Investment and Finance Company Limited. To discuss the 1Q FY24 performance of Chola and share industry and business updates, we have with us the senior management of Chola, represented by Mr. Vellayan Subbiah, Chairman and Non-Executive Director, Mr. Ravindra Kundu, Executive Director, and Mr. Arul Selvan, President and CFO. I would now like to hand over the call to Vellayan for his opening comments, after which we will take Q&As.
Nishin, thank you so much, and good morning, everybody. I just want to go through the unaudited financial results for the quarter ended June 30th, 2023. Our disbursements were at 20,015 crores for the quarter. Total AUM was at 122,755, which is up by 42% year on year. NIM was up at 2,127, which is up 30% year on year. And PBT was at 968 for the quarter, which is up by 27%. The NBFC retail industry AUM growth is expected to be 18 to 20% in FY24. Secured NBFC retail loans, consisting of vehicle finance and other secured business loans, is forecasted to grow at 14 to 16%. Chola's growth momentum continues in Q1 FY24 across its diversified business segments. In terms of our quick performance highlights, aggregate disbursements, like I said, are at 20,015 crores. Vehicle finance disbursements were at 11,301 crores as against 8,562 crores, registering a growth of 32%. Our loan against property disbursements were at 2,679 as against 2,036 crores, which is a growth of 32%. Our home loans, which includes our affordable home loans and affordable LAP, disbursed 1,454 crores in Q1 FY24 as against 611 crores in Q1 FY23, a growth of 138%. Our SME business disbursed 2,045 in Q1 FY24, which is a 98% growth over the FY23 number. And consumer and small enterprise loans disbursed 2,355 crores in Q1 FY24 as against 1,055, which is a growth of 123%. And secured business and personal loans disbursed 182 crores in Q1 FY24. So like I said, the total assets under management stood at 122,755 compared to 86,703, which is a growth of 42% year on year. So obviously, kind of one of the PBT growth is at 27% as compared to our overall asset growth of 42%. This is primarily due to two reasons. So one is that the fact that the cost of funds was lowest in Q1 of FY23 and progressively increased over the quarters last year. So on a quarter-to-quarter comparison, that swing is fairly significant. And then the second is that vehicle finance book is a fixed rate book. So repricing of that portfolio happens progressively as the proportion of new book is replaced with higher yield. So we're beginning to see that, and so I think that this will begin to adjust in upcoming quarters. The PBT ROA for Q1 F124 was at 3.3%. The ROE was at 19.9%. The company continues to hold a strong liquidity position with 7,069 crores of cash balance at the end of June 2023, including 1,500 to 1,600 crores invested in GSEC and T-bills, which is shown under investment. For a total liquidity position of 9,479 crores, including undrawn sanction lines. The ALM is comfortable with no cumulative negative mismatches across any time bucket. Our consolidated PBT was at 956 as against 764, which is a growth of 25%. Asset quality-wise, stage 3 levels have marginally increased to 3.06 in June 23 from 3.01 in March 23. GNPA as per RBI norms is reduced to 4.3 as against 4.63, and NNPA has also dropped to 2.82 as against 3.11. NNPA is below the 6% threshold prescribed by RBI for PCA. The details we will basically share with you. But the capital adequacy ratio for the company was at 17.44% as against regulatory requirement of 15%. Tier 1 capital was at 15.14% and Tier 2 capital was at 2.3%. The Board of Directors at the meeting held yesterday afternoon, subject to the approval of shareholders, approved a proposal for capital raising by way of QIP, equity and or CCDs at a price to be determined under the SEBI regulations 2018. We are targeting to raise 4,000 crores by way of these instruments, subject to necessary approvals. I will stop with that, Nishant, and we'll be happy to turn it over to the audience for Q&A.
Thank you very much. We'll now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Participants, you may press star and 1 to ask a question. The first question is from the line of Suresh Ganapathy from Macquarie Capital. Please go ahead.
Yeah, hi. Good morning, Vellayan. I had a question on the credit cycle itself. I mean, Vellayan, how do you read this? You have grown at 40% and growth across all categories, whether it is banks, NBFCs, is so strong. How do you see the situation on the ground? What explains such strong demand and asset quality outcomes?
Yeah, so Suresh, I'd say it's a good question. So if we take the different businesses, right, actually kind of the advantage we've had in some of the smaller businesses, at least for us, right, are that, our starting position is very small, right? So let me take vehicle finance. If you see vehicle finance overall, obviously kind of there, it's a more mature product. It's also a product where we have larger penetration and, but we do see strong demand still kind of across segments in that business as well. But obviously growth for us is a bit more, is limited compared to the growth we've seen in some of the other segments. Now, what's interesting in the other segments is that, I would say kind of first off, how home loans continues to kind of see, very strong, potential for growth because the segments we're going into, we see as significantly underserved and we're seeing a lot of good demand in those segments. The one area where obviously kind of there are concerns, and actually kind of like, once you get to the smaller loans, right, kind of both unsecured and secured, there are certain pockets where, we are seeing, a certain, caution that we're developing because in certain pockets we are seeing, kind of a bit of, over lending and therefore we're getting more cautious. So we're really taking we're taking the same micro market view that we used to take with vehicle finance and bringing it out to these other segments. And so taking a fairly cautious view in areas where we're beginning to see a little stress. The stress is actually, so there's not really a demand slowdown, but we're seeing kind of a bit of oversupply into a couple of areas. Can you put it that?
Okay, but coinciding with this, you have also seen your other business NPLs actually having gone up. I know it's a small base. 0.7% has gone to 1.1. Anything that we should read into it, or just a seasonal thing, or will you slow down this segment a little bit going forward? How should we read into it?
So Suresh, I'll give my commentary and then I'll have Ravi add with his comments as well. See, basically the other businesses, kind of, at least the ones that, the newer ones, kind of, the book is just building, right? So we've always said that, right? Which is kind of having an extremely small NPA is not going to be kind of sustainable in that business. So some of it is just the book building. We continue to kind of have a high degree of confidence in terms of the segments and our ability to kind of grow in them. So we don't see any concern from, what we're seeing as, like you said, a movement from 0.7 to 1.1. And Ravi, why don't you add your thoughts and comments?
Yeah, Sarul here, sir. So here we expect, and we have also articulated that it will be in the range of around 1.2 to 1.5%, and I think we are still well within that limit in the new businesses. They will tend to have slightly higher NCLs as compared to the previous other mature businesses because they are of a slightly risky nature, which is more than adequately compensated by the yields. But we are still running them at a much tighter levels and even lower than existing products because we are being very selective about the customer profile right now we are working on.
Okay, thanks so much.
Thank you. Next question is from the line of Abhijit Tibrewal from Motilal Oswal. Please go ahead.
Yeah, good morning everyone and thank you for taking my question. So again, a bit of a mixed quarter which is there are 2-3 points that I need your help to understand why they happened. You just touched upon NCLs in the newer businesses being higher but being compensated by higher yields. So again, when we look at the reported numbers, the gross credit costs in the newer businesses works out to somewhere around 5%. Again, this is your overall credit costs, and I remove the vehicle home loan slab credit costs and divide it by the average loans outstanding or the book outstanding new loans. It works out to about 5%. So are these gross credit costs and are there some recoveries from your partners under some FLDG arrangements because of which the net credit costs in the newer businesses were lower than what they are looking like? And so a related question here, in the newer businesses, particularly CSEL, what is the collection efficiency that you are seeing today? What is the bounce rate that you are seeing in the CSEL business space? So why I ask this is, in the past you have articulated that you will not shy away from slowing down in the newer businesses if the delinquencies are higher than what you have budgeted for. So are you seeing some early signs of stress, and also given the fact that recently the narrative around some of the peers acknowledging stress in rural personal loans? So are we what Viran sir was explaining, taking a cautious view in personal loans now and concentrating more on professional loans, business loans, or how are we thinking about the CSEL business?
See, you are right in the extent what I think I did in the NCL. What is happening is the two parts in the NCL. One is we have a FLDG recovery of around 35 odd crores, which is shown at the gross level in NCL, and the FLDG recovery comes in as an income line. So this is another Ind AS. So around 35 crores should be lower in the NCL numbers for the new businesses. The second part is, as the new businesses scales up, they need to be also provided with standard assets provisioning, equivalent of standard assets provision under the PDLGD norm. So that would also add up to the overall number. So between both these, your provisioning number will look higher when you see these numbers as a reduction of the total NCL minus the three businesses we have reported. But for it, we are not seeing any significant increase in our credit risk, and we are from that angle we are not slowing down any of the new businesses.
So just to add, actually,
I don't think. I don't know if you interpreted it as kind of we are going cautious on the new business. What I said is that kind of there are some. This is true always in kind of vehicle or any other businesses we're in, right? Which is there are always some micro markets which we will be cautious on. But overall, do we continue to be very optimistic and see a lot of growth potential? And we will see kind of growth in the new businesses, absolutely. So, I don't think that this should be interpreted as kind of turning overly cautious, right? Which could be one of them.
Got it, sir. Sir, I mean, just a follow-up question before I ask my next question to Ravi, sir. So basically what I infer is we are not seeing any higher delinquencies in the newer businesses, which will kind of make us cautious. And at the same time, what Arun sir was explaining, there is that component of FLDG recovery, standard asset provisioning. So nothing outright alarming in the newer businesses is what you are seeing, is what I'm referring here or inferring here.
Correct.
So hope that is correct. So the next question, the last question that I have is for Ravi sir. Sir, how should we look at the yield trajectory in vehicle finance? The fact that we are not seeing yields picking up in vehicle finance, not just for you, but I think at the industry level today. Is it a combination of your competitive intensity that you're seeing, or product mix, or what some of the peers have explained, some higher yielding books running off, which is kind of leading to this? And sir, what could be the difference today between your book yield and disbursement yields today in vehicle finance?
So in the vehicle finance, because of the nature of the business, this income, you have to see the four factor. One important is that book yield versus the marginal book yield. So marginal book yield is as of now higher by 1%. So that is one thing. But in the case of the book yield, it is lower by 15 basis points. So that's point number one. And why it is? Because the business what we booked in 2018, 19, 20, at that point in time, because the cost of fund was high, we were actually booking with much higher rate. Those agreements are running down. So therefore, after that, what is actually booked was the lower rate, and we are pouring the new businesses, which is at the higher rate. So the mix is, as of now, catching up, and it will take 2 quarters to reach to the level of what we want to basically see from the interest income line, pure yield line. So that's one thing. Second is that the other income lines. The other income line is also lower by 15 basis point, because other income is actually the bad debt recovery, the fee income, the insurance income, the cross-sell income, the additional finance charges, CBC, FBC collection. All these things actually start from Q1 at a lower level because of the collection is a lean period, and then it picks up during the 3 to 4 quarter. And third and fourth quarter, we will see that will also start delivering at a higher level. That's the point number 2. Point number 3 is the product mix. Now, if you see that continuously the new vehicle businesses are actually higher level, and we are maintaining our market share in that business. And so there is a mix between the high yield versus the low yield. And as long as the new businesses are doing well in terms of the industry sales, we need to continue to participate and maintain our market share. At the same time, we are trying to increase our yield through increasing our business focus on the used businesses as well. Used businesses are growing much better, but at the same time, the car sales was up by 10% at industry level, and we have been participating in one of the major manufacturers. So we have also gained a little bit market share. So that need to be continued because of the business strategy. So product mix is also as such that it is not allowing us to increase the marginal book yield significantly. We have increased it 100 basis point by June quarter. But in the month of July, it has gone up by 130 basis points. So it's going up, quarter and month on month, and you will see that we will start showing up those numbers in the book yield in the quarter 2 end or maximum quarter 3 end. So that's the third thing. And fourth one is that the cost of fund itself. So cost of fund was the lowest in the June quarter. And subsequently, you will see that the cost of fund started going up. So difference between the cost of fund now and the previous quarter will start coming down. So the overall NIM will also going up that way. So what we are saying, in the vehicle finance business, we are down, say, 14.9 to 14.6. There is a 30 basis point reduction. And the cost of fund has gone up from 6% to 7.3. So 1.3% increase. So 1.6% of the gap in the NIM is getting reduced by reducing the OPEX from 3.3 to 2.9, and the losses has come down from 2.1 to 1.5. So therefore, at the end, ROA is looking down by 60 basis point. Now, this 60 basis point is our problem, not that the 150 basis point total. So this 60 basis point in the subsequent quarter, you will see that the gap will continue to go down because the losses will further go down. Because we are starting from 1.5, we will be ending at 1% or less than that. So that way you will see that the losses line will start showing reduction and the ROTA will go up. And at the end of the day, we have been always saying that if you go line by line, it is difficult to manage. We should always see the ROA. As of now, we are 60 basis point lower than the ROA. That is because of the fixed versus the floating book concept, which will get covered up in next 2 to 3 quarters.
Thank you. Sorry to interrupt you, Abhijit. I'll request you to join the queue again for a follow-up question. I request to all the participants, please restrict to 2 questions per participant. The next question is from the line of Gaurav Kochar from Mirae Asset. Please go ahead.
Yeah, hi, good morning, everyone. Thanks for taking my questions. A couple of questions. Firstly, just extending the question on credit cost. You mentioned there are certain cohorts and micro markets where the stress is visible. So if you were to split, let's say your stress or the credit cost where it came from your in-house sourced customer book and the partnership sourced customer book, will it be more skewed or largely skewed towards the fintech and other partners?
See, actually, I think you have misunderstood the point what Mr. Villan was making it. He said that we have introduced the similar micro market model of managing the predicting the probability of default. That doesn't mean that we have seen that problem. In our case, in the new businesses, the partnership business, which is a small ticket, a small tenor loan, where the FLDGs are something which is coming up, and that is getting accounted in the income line. To that extent, we are actually booking the losses. That is one. Okay, that will continue to happen, which is a small portion. The majority of the net credit cost which is being shown under the new business line is actually the provision created for the standard asset. So the standard asset provision is actually almost 60% of the total NCL which is being considered now, because we have not given any page on that, but all of you are working out total minus VF minus HL minus LAP. So that is what I'm trying to explain you, that our PL or BL book of the CSEL is actually behaving the same manner. Our bounce rates are lower than the market. It is still at 5.6%. Basically, in the market, it goes up to almost 13 to 14% bounce rate. We are much lower. Our collection efficiency is 99.5%. So the losses which you are seeing it on the NCL line on account of the new businesses, majority of the business is actually coming from the either standard asset provision or the counter entry of the FLDG.
Okay, understood. And this second question is on the cost of funds.
Yeah, please, go ahead.
Yeah, on the cost of funds side, there is a 40 basis point inch up in cost of funds. Is that largely done now, or the repricing of your borrowings, which were linked to MCLR or otherwise, is that largely done, or you believe there could be further inch up of cost of funds from here on in the second and third quarter?
It is largely done. The only caveat I would say is if there are further increases that's happening because of any external events, yes, then there would be a fallout of that. But as of now, it looks like there will be no further increases by the regulators. So if that continues, then there should be, actually we should see some improvements therein. So I don't see further increases more on the cost of funds.
Okay, just to be a little more specific here, roughly half of your borrowing is bank borrowing. What percentage of that would have already repriced, or what would be the gap between the marginal cost of bank borrowing and the stock cost?
If you look at it, if I look at my total borrowing, 55 to 60% would be bank-related borrowings. The rest are all fixed-rate borrowings. The bank-related borrowings have got, out of the 60%, around 10% which is fixed rate by itself. So there is no movement that is forecasted on that. The rest are either repo rate linked or MCLR linked or the T-bill linked. So in the case of the repo link rates, we are negotiated the spreads on the repo because we would have agreed on a higher spread in the earlier period when repo was lower. So we are renegotiating with many of the banks, and we have built-in clauses with the banks to repay in case their negotiations fail at the times of every reset. So wherever resets are coming up, we do renegotiate with the banks. Not saying in all cases we'll be successful, but in some cases, wherever we are successful, we have been able to pull down the rates. So the new loans are coming at fairly decent rates because we are now, as you have also seen, that we have now shifted our focus on to doing more of securitization. And when we do securitization, we do priority sector assets, which gets us better rates than simply borrowing at the MCLR rates from the bank. So the securitization route, adopting the priority sector as our key factor to negotiate, has helped us, and so we have done almost like 8,800 crores in Q1. So this impact of this would also flow through. Another reason why the cost of funds has also impacted marginally is we consciously built up our Tier 2 during the Q1 by issuing certain amount of perpetual debts as well as subordinated debts because we wanted to build the Tier 2 part of it. So that impact of it is always showing up. But that would continue because that's a fixed rate book. But it's a small number, it's around 500 crores.
Sure. Thank you so much, sir.
Thank you. Next question is from the line of Prashant Sridhar from SBI Mutual Fund. Please go ahead.
Yeah, hi.
Prashant, you're not audible. May I request?
Sorry, am I audible now?
Yes.
Yeah. Thanks, sir. Two questions, sir. So one is on the retail unsecured piece and the new businesses. If you could just help us understand how you are tracking how the customer is getting over leveraged and what do you do when you find out that is over leveraged? And number two is just a technical question. So the loan book has grown at like 40% and the ROE is around 20%. So how has the tier 1 capital adequacy increased versus last quarter? Yeah, just these two for myself.
Right. Actually, the answer lies in the questions because from
Prashant, may I request you to mute your line from your side, please? There's some very disturbance coming from your line. Thank you.
Yeah. So, from a capital adequacy point of view, securitization is not treated as debt. It is adjusted out of the risk-weighted assets because under the capital adequacy, when we are securitizing the book, we can adjust the securitized assets, and that's where you are seeing a good amount of Tier 1 improvement happening. Again, as I said, some amount of perpetual debt has also been done. This has helped us. So, in the leverage ratio, we don't consider it that way because under Ind AS, securitization is shown as borrowing now. Earlier under the IGAAP, it was shown outside the book. So it keeps changing. So from that angle, now the leverage will look because the securitization does not move the needle on the debt equity ratio.
In the case of underwriting of the personal loan business, one important thing is that we have to understand what we are doing under the CSEL division. We are doing three types of business. One is that the partnership business, which is small ticket size, small tenor book, and that is purely going to the salaried class. And we have mentioned that these are all getting disbursed 720 plus scores. Then the business loan, which we are doing it with the self-employed non-professional customer and also doing it with the professional like doctor, engineer, chartered accountant, which is basically, again, we are doing 720 plus customer. Majority of the customers are there. 96% customers are 720 and 4% customers between 700 to 720%. Now, third customer is the personal loan, which we started recently, and we have not done much personal loan because in the personal loan, it is mainly salaried class who gets the personal loan, and we industry categorize the employer, Cat A, Cat B, Cat C type, and all Cat A, B, C get funded by the banks at a much lower rate. DE type of employer where employees are working, the salaries are lower, they're getting funding by the NBFCs. So we saw that it is actually one that the yield is lower as compared to the business loan, and second is that why should we will take the risk for the E and F category of the employer where the employees are working. So therefore we have not done the personal loan business. We are only going to do direct with the direct sales team and also with the existing customer mainly. So now coming to the evaluation whether the leverage or not leverage is depending on, one is that the credit score itself that the customer is taken the loan and paying it in time. Second is that how much EMI customer is paying and what is the total income of the customer. So what Mr. Velan was also trying to say that if there is a over dependency or customer has taken loan and paying more installment, obviously that will not get through in our system, and obviously it is getting rejected. In some market it is found that the customers are having little higher leverage, and obviously we are not reducing our credit score, bureau score and credit score which is required for clearing the proposal from 720 to 700 for PL loan, and that is what is the basis of underwriting. So the leverage is actually taken care by evaluation of the income to the EMI burden of the customer plus the credit score which is coming out from the bureau and from the underwriting tool what we have developed for our system.
Sure. No, so that's quite helpful. Just
I'm sorry to interrupt you. May I request you to rejoin the queue again for a follow-up question?
Sure. Yeah.
Thank you. A request to all the participants, please restrict to one question per participant as we have a long queue. The next question is from the line of Umang Shah from Kotak Mutual Fund. Please go ahead.
Yeah. Hi, am I audible?
Yeah.
Yes.
Yeah. Thanks for taking my question, sir. Just one thing on ECL provisions, especially on the standard assets. So if I look at our stage 1 and 2 provisions, they have kind of pretty much normalized back to pre-COVID levels. So I'm talking about stage 1 and 2 provisions combined. However, given that the overall AUM mix is shifting now in favor of new businesses which inherently have higher forward flow rates, should we expect that our standard asset provisioning requirement might actually increase going forward? How should we look into it?
Yes, it will marginally increase because we are evaluating. See, what we are doing right now is we don't have enough traction on the existing book to arrive at PD LGDs for the new businesses. So we are adopting a very conservative way of looking at it. Either in the case, for example, in SBPL and SME, we are following the LAP model, and in the case of CSEL, we are trying to put a provision which is more stringent than what is either for VF or any of the secured businesses. But by end of March, we would have around 24 months or plus of the businesses, which would give us the traction to arrive at the PD LGDs. So by March end, March 24, we should arrive at PD LGDs for these businesses, and thereafter it will change accordingly.
Okay, but despite that, we believe that we would be able to contain our credit cost within our guided range.
Yes, as I said, actually, in my opinion, at that point in time, there could be, because we are now pursuing an aggressive provisioning norm with regard to the new businesses, there should be, PD LGDs should show a reduction, in my view. But let us wait for the numbers to come up rather than, take a call notionally on this.
All right. Thank you so much and wish you good luck. Thanks.
Next question is from the line of Kunal Shah from Citigroup. Please go ahead.
Yeah, thanks for taking the question. So last time you highlighted that in terms of the credit cost, it should vary in the range of 0.75 to 1.1, 1.2. We have seen a slightly higher credit cost in 1Q. So how should it actually pan out? Because vehicle has been higher as well as on the new businesses, it's been upwards of 4.5%. So do we still stick to that kind of a guidance? Are we confident that it will still sustain below 0.9?
So if you see that in the vehicle finance, we started actually showing up lower NCL than the Q1. It has come down. I have mentioned that in the previous, when I was answering it, the last question itself. If you see that in our investor presentation itself, is very clear that it has come down from 2.1 to 1.5. So last year at the overall level, NCL was 1.2 for FY23. We started from 2.1 to 1, ended up for the entire book, entire year is 1.2. If you start at a 1.5, obviously it will go down below 1%, no?
Yeah. Okay. So in fact, it's more of a Q1 thing, and
it's a Q1 thing, and also it is from where you are starting. You are starting 60 basis point lower than the Q1 number, isn't it? And as of now, if you see that in last time, if you see the stage 3 of the vehicle finance in the Q1, it went up significantly at that time. But here today in this quarter, Q1 to Q3, is the increase in the stage 3 is only from 3.01 to 3.35, which is hardly 30 basis points. So as against the increase of 70 basis points, 15 basis points. For now it is only 15 basis points, 3.2 to 3.35. So we have two advantage here. One, that the NPA is not going up, stage 3 is not going up, and stage 2 is actually showing a much better situation. It is actually now stage 2 has come down, in fact, from the same, if you compare it. So if you take the two important points, one is that the NCL of Q1 2.1 to 1.5 now is coming down by 60 basis point, and at the end, when we started with 2.1, we delivered 1.2 for the year. Obviously, the NCL will go down. And again, second thing, the stage 2 is stage 3 where we are in now as compared to the Q4. And similarly, if you go Q4 to Q1 last year, you see that our book is also behaving much better than what it was like last year.
Sure. And secondly, in terms of this FLDG, so no doubt it's P&L neutral because it's there in the other income as well as in the provisioning. But does that really show that maybe the stress in that pocket is higher than what we would have anticipated, and that's where this entire FLDG is coming through?
No, actually, this is actually not that all of these FLDGs happened during the current quarter. What has happened is we had been pursuing this with the partners, and these have been, we needed to account it out this year because this quarter because of the new norms of the RBI, where we needed to consider them as write-off on one end and then only recognize the FLDG on the other side. So that is the reason why we needed to bring them into books. Otherwise, it's not like all of them had happened in this quarter.
Okay, so this is cumulative.
Cumulative, yes. Cumulative FLDG is being accounted, yes.
Okay, yeah. Thank you. Thanks.
Thank you. Next question is from the line of Viral Shah from IIFL Securities. Please go ahead.
Yeah, hi sir. Thank you. I had two questions. So again, just going into the new businesses. So you mentioned, of course, it's a function of the standard asset provisioning. Can you give a breakup of what was the standard asset provisioning, what was the NPA provisioning, and what was the write-off for the new business?
I don't think at this juncture we are giving that breakup. When we start presenting the new business P&L, we will start giving this information.
Okay, but as you mentioned, majority of it is due to standard asset provisioning and not write-offs.
Yes, I still stay by that, but I'm saying I don't have to give you the breakups because we have not yet started presenting the individual profitabilities of these businesses. So kindly wait for the end of the financial year when we will start presenting these numbers.
Sure. So then, so how should one look at the profitability of these new businesses? Because earlier you had mentioned that the ROAs for these businesses are significantly higher than the current business. Does that still remain?
Yeah. ROA of these businesses will be higher than the existing businesses. As of now, they are still either equal to or marginally even lesser than the existing businesses because they are on the growth phase and cost is high. The operating costs are higher.
Got it, sir. And just one last question from my side. Can you give some color on the digital platforms that you are building, basically the Gaadi Bazaar and the Chola One app that you are building for the personal loans?
Yeah, sure. So Gadi Bazaar app, we have built quite a few facility feature in that. One is that all our repo stock, which is almost close to 3,000 units per month, we are selling it digitally on by listing it and by putting it up with photographs and valuation and everything, and customer can evaluate the buy, and then they can quote, and this online quoting bidding is happening. So we are doing that part. So that way we are able to one that realize the best value of the thing, and it is also transparent, and there is no chance of any kind of wrong dealing happening in the branches, because we are working from 1150 branches, and we have resident location close to 500. So all 1,600 branches are doing this thing, but all the vehicles are getting sold in a same manner. One is that. Second is that we have more than 5,000 dealers are there in vehicle finance division, where we are dealing with them, and all the people who are taking the trade advances and close to 1,600 crore of trade advances getting disbursed every month. That is getting done. So empanelment of dealer, request of the trade advances, and replenishment of the trade advances, everything is online, digitally done, which used to be done earlier completely file based manner. That's the second thing. And third important is that we have also created a used vehicle marketplace, and across the country we have close to say 10,000 used vehicle dealer. All of them are basically doing the transaction with us. So their stock is getting listed in our platform, and to that extent we are generating the lead for buy and sale, and we are helping their stock to dispose of, and therefore we are also able to generate the revenue from them. So one is that the used vehicle marketplace, where we are generating revenue by helping them to generate the lead and sell the vehicle. Second is that we are also able to do the dealer trade advance through our PA portal, and third is that the used vehicle marketplace, repo vehicle marketplace, where we are disposing our vehicle at a much better price, and we are also generating revenue through that. The fourth one is the customer service. The customer service is again two type of services we are giving. All the customer grievances or requests which is coming through physical mode by through branches or through the call center, now today they can actually approach us in the digital way, and almost 96% of the customer request, customer services are now getting delivered digitally, and they are also able to pay digitally using our Gadi Bazaar app. Almost 150 crore collection is happening through the Gadi Bazaar app. So this is what in the Gadi Bazaar, which is vehicle finance ecosystem, digitally we are enabling customers and our dealer and our broker and our used vehicle partner to work with us. In addition to that, we have also given this app to our repo agent who can actually get the details of the vehicle, where to be need to be repurchased. They can submit the bills, the bills can be paid. So that's the additional services we have given. In the case of Chola One app, which we have launched it for CSEL, we are doing digital lending similar to what we are doing it with the partner, but it is actually internally done for the employees as of now, for the Murugappa Group ecosystem, and it is actually done almost 4 to 5 crore. We have started doing it in this platform. We are testing this platform and trying to see that what is the delinquency, what is the bounce rate, and then slowly we'll open it up for the market.
Got it, sir.
Thank you.
Thank you, sir.
A request to all the participants, please restrict to one question per participant. Next question is from the line of Kaitav Shah from Anand Rathi. Please go ahead. Kaitav Shah, may I request you to unmute your line and go ahead with the question, please?
Hello.
Yes, go ahead, please.
Yeah, thank you. Sir, I just wanted to understand more at a macro level. If you can help us understand about the sustainability of the growth rates that you're seeing over a 3 to 5 year period. I know new businesses are very small, but is there any structural change that you're seeing at the ground level that you can make us more aware about? Thank you.
As Mr. Vellayan mentioned that affordable housing is something which we see that it is very less penetrated across the country. Even in the case of Chola, whatever business we used to do 1 year back, 80% business used to come from South Zone. East, West, North were under-penetrated from Chola's point of view also. So we have started doing it, and as of now, our penetration in non-South is 40% and 60% we are doing it in, South. That is one. Second is that we need to also see that what are the, type of product which you can, give it to the customer who are going for affordable housing. So we see that only few customer profile is only, their needs are addressed. Almost, 60% of the customer profiles are not getting addressed in affordable housing still because of the properties within the municipal limit or out of municipal limit, type of property, what type of income they are generating, what is the source of income they are generating, are they getting income through, bank to bank or is getting through cash salary. So there are many ways to basically increase the penetration both from a geographical point of view and as well as customer profile point of view. So home loan affordable home loan is something which we are expecting that to grow continuously, much higher rate for the next 3 to 4 years or maybe more than that. Now coming to the loan against property, where we have seen that significant growth coming up during last 1 year, 1.5 years, that's because we were operating from 350 branches, now we are operating from 600 branches. And still we have, another 600, 700 branches to go up. And we have launched the micro LAP also in the LAP businesses, which is basically a small ticket size loan, because our surface is now available up to 20 lakh rupee. And as you may go in tier 2, tier 3 town, those customers who are having a small property will be coming up, and they are also paying much better than what bigger LAP customers are paying. So both and their delinquency levels are also much lower. We have seen that the bounce rates are lower, the collection efficiency is very good. So we see that the second largest business which is going to grow within the existing businesses is going to be the LAP. And third is the vehicle. You see that the industry itself has not reached to the peak level of pre-COVID, and it will continue to go up to reach over there. And we know that the penetration in vehicle finance in terms of cars or tractors or two-wheelers is much lower in India. So that will increase the vehicle, but vehicle finance growth will be lower than LAP and HL obviously. But we are expecting that it should be 20% for next few years. Now coming to the new businesses just opened up, and since they are in growth phase, they will continue to grow because of the lower base. So in nutshell, Chola, all 6 business lines put together, we are quite confident that we will be delivering at least 20% disbursement growth. Conservatively, we are telling you, but it can actually go up as we further, talk and discuss.
Sure. Thank you. That's it from my side.
Thank you. Next question is from the line of Beauty Chawla from IDBI Capital. Please go ahead.
Yeah, thank you for giving me the opportunity. Just one data point if you can share, as we are not highlighting much in the presentation about the restructured assets. So are there any restructured assets left in our books? And also, I believe that moratorium of these restructured assets is completely now out of the move, and now they are kind of a standard assets for us.
We have around 2,200 crores of restructured assets, of which around 300 crores is in stage 1, 1,500 crores continues to be in stage 2. That means they are performing, but they are not moving back to stage 1 because they have not yet come to 30% level as per RBI norms, where we can move them to stage 1. And I think a residual 500 crores is in stage 3 because they are not performed and they moved to stage 3, and we have started providing for them as per the normal, PDLGDs of them.
Okay, thank you very much, sir, and congratulations.
Thank you.
Thank you. Next question is from the line of Avinash Singh from MK Global Financial. Please go ahead.
Yeah, hi. Sir, one question on your newer businesses particularly. The kind of customer segment and the credit score you are sort of competing. So what kind of yield, because your growth of course from a smaller base is very, very strong. So what kind of yield, if you were to compare versus your peers in that segment, offering, is the yield sort of at parity or I mean, there is some sort of a differential in yield, particularly given the fact that you are more focusing on that 720 plus customers. Thanks.
Our yields are actually almost in line with the market, and in fact slightly better than that, both the yield and fee income put together as of now, because we are not aggressively growing. And when we say aggressively, it is the market potential versus what we are doing. But when you see our comparison with what we have done versus what we have done in the past, obviously you see that the percentages are high. So I'm again and again saying that as against the market size of the personal loan or business loan or SBPL business, we are quite small, and therefore we are able to maintain both credit score at a higher level and the yield and fee income at a higher level, and we are by that still we are able to deliver lowest bounce rate and highest collection efficiency.
Okay.
Thank you. Next question is from the line of Pranav from Rare Enterprises. Please go ahead.
Hi, sir. Thanks a lot. Sir, can you hear me?
Yeah. Please go ahead.
Yeah, sir. I joined the call, so forgive me if someone has asked this question already. Sir, your ALM is very, very tightly matched for next 2 years. And second thing is that if we just see the new business NPA on a 12-month lagging book, so 12 months ago, whatever the book was, I think it was around 2,200 crore, and current NPA is around above 100 crore. So it's almost around 4% of 12-month lagging book. So that is second point, and the disbursement in that area is very high. So actually, how you see this situation? Because the area where if the growth slows down in that area, eventually it will have 4 to 5, 6% NPAs, And Chola was always known for a very conservative group. So even if you just say raise capital, why not just improve ALM rather than have a growth in the new areas where whatever theoretical PGD is, system PGD will also be tested. So why not slow down the growth? Thanks.
No, I'm a little confused. You are mixing ALM and NCL and NPA percentages.
Yes, because what happens if 5% GNPA becomes to the NPL? That is also
5% GNPA is not there actually. That is wrong number.
I don't know.
Actually, stage 3 we have given in page number 28 for the other businesses where the new businesses are included is 1.01%, which is
that is on the current book, so I am calculating it on the book.
We can notionally say any number and then assume. First of all, let me address your ALM query. You are saying ALM is tightly matched. ALM, as per regulation also, you can have cumulative mismatch of 10% for the first year, and thereafter actually cumulative mismatches are also allowed. But internally we follow a much more aggressive policy that there will be no mismatches in any bucket. But that is on the cumulative number. And I think it is well understood that you need to track cumulatively, because the surplus of the earlier time buckets should flow to the subsequent time buckets. Right. So so if you look at it at any point in time over the cycles, we have shown that our cumulative mismatches are never negative. Notionally we can keep, assuming can I be better than this, we can work on it. But there is a other side efficiency angle to it, because then you have to create more and more of reserves or cash reserves which are not going to be cost of funds accretive for you. It will not be, it will have a negative impact on your cost of funds. So we have gone through various cycles and we have never ever faced an ALM issue, and I think the way we are managing it is quite optimal, I would say, if not conservative by itself. So beyond this, assume, and we have our risks team putting different stress testing analysis on this at moderate stress, high stress, and so that stress testing is also being done to ensure both from an ALM perspective and purely from a liquidity perspective things are well managed. Right. So sitting from outside, assuming a 10% NPA and then what could happen to the to the ALM is a little long shot. I would stop there.
Right. So, sir, on a trailing basis, there is no like there is some merit in considering current GNP on a 1 year back book, right? Because you are not lending this quarter and it is becoming GNP in the same quarter. So, am I wrong in thinking that?
So we do all these analyses by following the static pool analysis, and actually 1 year back issue is a different issue, COVID, which is more a one-time phenomena. We have to look at periods where it is of a normal trend and we factor in certain amount. But even if you take the PD LGDs, it factors in even the COVID period and then considers it. That's what I was explaining earlier, that the provision coverage will look higher because of these the PD LGDs are calculated with 2 years of the COVID period also coming into play. So I think we take care of all this, and we try and build the book as well as our accounting in a very conservative way. Yes, the views are welcome.
Thank you. I request you to join the queue again for a follow-up question. Next question is from the line of Piran Engineer from CLSA. Please go ahead.
Yeah, hi. Congrats on the quarter and thanks for taking my questions. Just a couple of them. Firstly, any one-off in the employee expense which has dropped 15% QOQ? Have you moved people to off-roll or something like that? And secondly, the Tier 1 ratio has increased QOQ. Sir, you were mentioning something about securitized assets not being counted in capital adequacy or something like that. So, are these two related? That's it from my end.
They are not related. See, we are talking expenses. Expenses is expenses as being as the
No, I mean
I think Arul, his question is securitization related to Tier 1.
Is that related?
Yes. Sure. Okay. So I think So Arul, you already answered that, but he's asking the same question that was asked before.
Securitization.
Yeah. So, see, we did securitization. Securitization impacts Tier 1 because under the RBI regulation, CAR needs to be calculated in the erstwhile method. So there we take away from the risk-weighted assets the securitized book because these have been sold off to somebody. The loss levels that are expected on securitized book is to the extent of the cash collateral, which is adjusted straight out of the Tier 1, and that is the way the CAR is calculated. And factoring in that, we have improved the CAR.
Got it. Okay, that answers the second question. And the first one on employee effect.
Yeah, go ahead.
Yeah, employee expenses. If you're comparing Q4 versus Q1, yes, there would be reduction because in every Q4 we will have the full performance of the teams being evaluated and the incentives being factored in at their highest performance level.
And additional incentive.
And any additional incentives, increments, etc. would be factored in. In Q1, it will be not there because as such, we are in the starting mode and we will be providing them at a normal pace. In Q2, what will happen is certain amount of increments, promotions, etc. will be factored in. From July onwards, this impact will start coming in. But that should not be a significant number from an overall perspective. It happens every year.
Got it. Okay, that answers my question. Thank you.
Thank you. Next question is from the line of Ashwini from Edelweiss. Please go ahead.
Good afternoon. Good morning, sir. I've got a couple of questions. So in the month of July, we had seen some heavy rainfall and floods. So is it going to impact the disbursements, loan growth, or collections for this quarter?
So this time, if you see, the rains are actually good. There are some market, if you've seen that, it was slightly higher than that. But according to me, as against the El Nino effect, what people were worried about, entire country is having a good rain and it is almost 95-96% of the level. And few market where we have seen that a little deficit was there, like Bihar, Bengal, Jharkhand, and some market. There also now rains are expecting. So coming back to the growth, our July numbers are good, so no need to worry about it. We are maintaining the momentum.
Okay. And we will continue to maintain the current overall growth rates in the AUM and the ROAs, right?
Yeah.
Okay, sir. That's from my side. Thanks.
Thank you. I now hand the conference over to Mr. Nischint for closing comments. Nischint, can you hear us?
Thank you very much for joining us today. We thank the management of Chola to give us an opportunity to host this call. Thank you.
Thank you, Nischint. Thank you all.
Thank you. Thank you so much.
Thank you very much. Thank you very much. On behalf of Kotak Securities, that concludes this conference. Thank you for joining us. You may now disconnect your lines.